Welcome back to JPX Energy Market Weekly Updates. Crude oil market ended last week with little change. Oil market have come under pressure due to lingering banking concerns, worries of the US debt ceiling, and questions growing over how strong the Chinese recovery we're seeing. Middle East benchmark Dubai crude was down by more than 15% from month-ago levels, prompting speculation that the OPEC Plus producer alliance is planning to take further action when it meets in early June. However, Iraq does not expect OPEC Plus to make further cuts to oil output at its next meeting in June, as oil minister said in the first indication from an OPEC minister about a potential decision as oil prices slide. So far, there has been few clues on the June 4th in-person meeting in Vienna. At the microeconomic level, reaction to the latest U.S. inflation data was mixed. Headline CPI cooled to 4.9% year-on-year last month, down from 5% in March. Although it came below expectations, it remains worryingly high. However, the cooling inflation does give the Fed room to consider a pause in the June meeting. The last meeting between U.S. President and the top congressional leaders has been delayed until this week, just as Treasury Secretary Janet Yellen warned the failure to hike debt ceiling would cause an economic catastrophe. Washington's standoff over debt ceiling continued to cast shadow on oil markets, a potential trigger for greater volatility in the oil markets in the near term. However, financial markets this week seems more upbeat on prospect of Washington reaching agreement on the debt ceiling. On oil fundamentals, EIA expect a seasonal rise in oil consumption and a drop in OPEC crude production to put some upward pressure on crude oil prices in the coming month. The International Energy Agency has raised its oil forecast for this year by 200,000 barrels per day on record demand in China. Demand is forecast to outstrip supply by 2 million barrels per day in the second half of the year. OPEC's global oil demand forecast for 2023 was held steady for a third month and also further raised its forecast for Chinese oil demand growth this year. This consumption recovery will be the key focal point for oil markets for the rest of the year, so recent weaker economic data from China also weighed, casting doubt over the pace of its economy recovery. On the physical market, recent days there's been a recovery in gasoline diesel crack spread. However, the recent rally in diesel cracks, which have risen for the first time since early March, should not be expected to continue. The situation is fluid, with none of the demand centers showing particularly strong signs of demand, and we instead see something of race to the bottom to avoid receiving surplus barrel. Demand isn't sufficient to keep margins afloat. Refiners that had enjoyed strong profits in recent years were considered cutting output. While recessions in oil demand are difficult to predict, market watchers are keeping a close eye on the market structure or intermonth spread. The advantage of analyzing intermonth spread is that changes in the market fundamentals will likely be reflected in the spreads, as the intermonth spread of major oil benchmarks remain weak since last month, and recent rally in flat prices should be treated with caution. Okay, that's all we have for this week. Welcome back next week.